230 points out of nowhere. So let's discuss this today. I have Charles Nenner on the line, founder of Charles Nenner Research Center. His website is charlesnenner.com. Charles, thanks for coming on Crush the Street with me today.
You're welcome.
Charles, so we just received news that the U.S. trade deficit is now at a 9.5-year high. And this seems to be what Trump really focused on. This was like a big deal during his campaign. And, it seems to be, with this trade war arising, seems to be spooking the markets. What do you make of it?
Well, the question is, do people want to talk about news or they want to make money in the market? We have been saying since 2009, when we went long again, that by the last days of 2017, you should totally go out of the market and go short. So let me tell you a couple of things I published. If you watch on television, you see all the so-called pundits say the economy looks good, unemployment is at 4%, it can even go to 3.8, right? That's the argument. Now, the interesting thing is that if you make a chart for the last 70 years, every time the unemployment is around 4%, you have a market crash. But they continue. I try to intervene sometimes because I think a lot of people lose money because they listen to all this nonsense. So I try to intervene. I says, isn't it time that whoever says something is going to prove it? So I sent out my charts to all the agencies and the television station. I says, look here, every time the unemployment is at 4%, you have a market crash. How is it possible that you let people say that the economy is good and, unemployment is 4%, it's good for the market? Who were the people who bought in 2009? Those were clever people. Those people knew the news of today. That's
Right.
why they bought. If they would have thought everything is bad, they wouldn't have gone into the market. So they have been selling already a long time ago because they know that now we get all the news and it's over.
So that's it.
One more thing. I've been publishing something very, very simple. The year of the seven. You know the rule of the year of the seven?
I don't know it specifically. Is it a market cycle you're talking about?
Every year that ends with a 7 has a market crash. So let's think back. 2017 now is a bad situation. 2007, bad situation. 97 into 98, bad situation. The credit crisis, Russia, whatever, collapsed. 87, bad situation. 77, bad situation. So I published, I says, you want to see this for the next 100 years? You're not going to survive it. Why don't you assume that you have a market crash every time the year ends with a 7? Now, the interesting thing is, the very few people who make $1 million even in this year in the market coming down and have no clue why. Because what we say is we prove. It happens for the last 100 years. Wouldn't you take a chance if you know for 100% for sure that if you buy a lottery ticket, if it ends in a 7, you're going to make $100 million. You're not going to choose one with a 7. So I have no clue what's going on with all this market news, because it's absolutely nothing to do with it. Now, about yesterday. Yesterday was very simple. On different cycles, there was a cycle low. For people who don't watch my cycles, it stopped at a 200 moving average. All the institutions says, hey, we're right at a 200 moving average, buy, 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 buy. And then the media says, oh, there was such a crazy situation, it turned around. It turned around because it stopped at the 200 moving average, and all the pension fund institutions buy as long as it doesn't break below the 200 moving average. Nobody mentions these things. So everybody says Trump said, did China said. That has nothing to do with it.
So you mentioned every time unemployment gets to 4%, we see a market crash. And is it because of Keynesian economics that we're seeing that? Because they inject the economy with so much stimulus that we get these positive results, and then we get to a point where it bursts because, we have positive economic results such as a 4% unemployment, but we've overinflated the market and now things have to correct. Should that be expected, or what's your take on that?
Well, to tell you honestly, I have no take on that, because I am in the business of helping people make money and especially not lose money. And every time it's 4%, you have a market crash. Now, I don't care why. I personally think that the bigger guys know that it's very difficult to get below 4%. We're not going to 2%. So all the good news is in. So what are you going to expect now? So sell.
Good point. So how big of a market crash are you anticipating? Is this the market crash you're expecting, the lows that we're seeing now, or do you expect further moves down to come in the months ahead?
Well, first of all, you know that by 2020, I've been publishing this for years and years. The Dow's going to be at 5,000. And I have been on different situations warning the people, why don't you listen how markets work? People are going to laugh at you when you say it. They laughed at me when 2007, 8 when I said it. It's going to be a terrible situation. This whole economy is going to roll over. Interest rates are already low. There's not much the Fed can do anymore. The banks are not as safe as you think it is. You mentioned the trade war, very possible. It's going to be a big mess.
Charles, so does that 5,000 point prediction for the Dow, does it change as the Dow Jones continues to go higher and higher? Because, a 50% crash at 10,000 would give you $5,000 Dow, right? But a 50% crash at 20 is 10, and a 50% now where we're at is 12,500 roughly. So does it change? Does the floor of the crash rise as the Dow Jones goes higher?
If a market moves up with a certain momentum, we developed the algorithm years ago, then you can calculate the momentum, how high it will go. It doesn't stop at random. You can calculate mathematically exactly how high it's going. The low of 5,000 is projected from the low of 2009.
And why does it have to go to the same spot?
Sorry?
Why is it going to similar, a similar spot of 2009? What does 2009 have to do with this next crash?
Because the last low was in 2009, right?
Right.
Okay. It's like a ball that you throw and it goes up and down until it lies on the floor, right? So the market goes up and down, up and down. So you calculate the next low projected from the last big low was in 2009. And if you project it down, you get to 5,000.
So, Charles, I know you're not saying, trying to figure out why the markets are going to crash, but it's interesting that we have the cryptocurrency coming off of its big euphoric high here, and many are comparing it to the dot-com bubble. Of course, it was a much smaller market. The 800 billion that we saw was a much smaller valuation than the dot-coms ever got in 2000 or 2001, and but looking at that, it's curious that we are seeing the pullback in cryptos and the pullback in the markets, because the sucking out of the capital, even though it's not directly tied to stocks, tends to be a sentiment mover. And I'm just wondering, any thoughts on the cryptocurrency correction that we're seeing, and does it tie into the markets at all, in your opinion?
When cycles are down, everything turns bad. That's why the news is bad, trade war, whatever you mentioned, right? That's why the cryptocurrencies go down. That's why the stocks go down. It's all the same cycle. Now, the currency thing with the Bitcoin was an example. I remember just before the crash of 2000, maybe you remember, everybody was walking around with a T-shirt that says, "Don't worry, be happy." You remember that one?
Yes.
Okay, so that's exactly when tops are made. So when people, and I had friends, sell everything they have in order to buy Bitcoin, that's when tops are made in everything. So it's the atmosphere that has reached such an extreme. If you would look at the margin that people buy on margin, and you look at the high in 2000, and you look at the high of 2007, and you look now, it's uncomparable. Now it's through the roof. We thought it was high in 2000, 2007. You should look what it is now. Everybody bought on margin. So that's the atmosphere when a top is reached. And then suddenly when a cycle turns down, then we start realizing, well, how about this problem? How about that problem? How about this problem? Now it's Korea. All these things existed already, but nobody talked about it.
Right.
So it's not always that the facts change. I give you an example. Let's say you and I own IBM, and IBM is 100 and it goes to 150, and we own IBM, and IBM comes out with a result, and the result is great. Now the question is, does IBM go up or down? Well, if the result is great, it goes up maybe to 180, and the Wall Street Journal will publish that investors poured into IBM because the results were great. But if the same results came out and now it collapses, so what's the Wall Street going to write? The Wall Street Journal is going to write, people don't think IBM does better next year, so they took profit based on the same facts. So the facts won't help you investing. The interpretation of the facts is what you're looking for. And the cycle work we do will predict the psychological environment that the facts come in. As you know, the Fed only has to say maybe we will do something to interest rates. They will never do it, and it's already enough. The perception is what does it.
Yeah. We've talked about that a lot here. Perception is king in all of that. And it's interesting how far the government and central banks do to maintain that perception. And I think some of that might have been lost this week, but it's gaining that ground once again as markets over the last 2 days seem to be moving higher. But a week ago, I feel like perception was starting to slip.
Yeah, but you should know, if you look at my research, that we write close to a short-term cycle low. So that's why the perception changes, and that's why the market's going up.
Well, Charles, talk to us a little bit about what your research is telling us about gold, your thoughts on gold in this environment, and what do you see going forward here for the next couple of years in regards to gold?
Well, we have a major buying opportunity after the summer, and the projection for gold is 2,500. Now you're going to ask me why. I can usually tell you no clue, but I will tell you what I think is going to happen. Those story about inflation is brought up by people who have been in the business for the last 30 years. Like I know very big bond traders, they don't understand bonds can go down because as long as in the business, there was a bull market for bonds. So people who don't study the history of finance think inflation, 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 while most of the time in history, it was deflation, deflation, deflation. And we're going to have deflation. Everybody's on the wrong side. So now you ask me, how can gold up in a deflation? Because I thought it's going to go up in inflation. Well, gold goes up in deflation because stock market crashes in a real deflation. Housing market crashes. The bond market even, because yet the deflation crashes like you saw in Greece because they're very vulnerable because of the money system. And people are going to buy gold in order to have some safety.
Yep, I tend to agree with you on that. Charles, so any final thoughts on this, just kind of your general thoughts on the markets and what people should be doing to prepare themselves in 2018?
Well, if I may say is that, and I say always, go to our website. You get the research for a long period for free because it proves yourselves. We help you survive this enormous market situation that's coming. There is nowhere to hide. There's really nowhere to hide. The same thing will happen with the real estate. If you look at Toll Brothers, Lennar, whatever, these stocks are already down 25%. In London, New York, real estate is already down 15%. You're going to have the same situation all over again. And it's very hard for people to understand how it goes when the media fills you up with all situations that are not, doesn't show reality. I really like to have people look at reality. Don't listen to what people say. Just look at the numbers. And if the Fed says, well, we don't understand why inflation doesn't pick up, it's even the Fed. They don't seem to know the history of the Kondratiev cycle, and they don't understand it doesn't pick up because whatever you do, and the deflation cycle is down, it doesn't help. You can bring the interest rates to minus 10% or whatever. It's not going to help. So the problem is that everybody understands markets based on his history, that he has been in touch with reality, but that's not how it works. You have to understand the last 200 years to understand what's going to happen.
Yes.
So So I invite everybody to ask for free months, 2 months research. You get the exact dates, the exact levels that something happens. You look at the dates, and then next day you open the television, the paper, and then they're going to explain why it happened. And